Assalamu alaikum everyone. Welcome to our presentation. Here you can see the information of our group member and honorable teacher. Here is our objective, means the topic that we are going to describe. Firstly, we'll know what is debit. A debit is an expense or an amount of money paid from an account that result in the increase of an asset or a decrease in a liability or owner's equity on the balance sheet. Here is credit. What is credit? Credit is borrowed money that you can use to purchase goods and services when you need them. You get credit from a credit grantor, whom you agree to pay back the amount you spend, plus applicable finance charges at an agreed upon time. Here you can see debit and credit side. In my left, here is debit. Below that you can see asset expense drawing. Means if any of them increase, that will go to this debit side. If any of them decrease, then that will go to the credit side. Just like that, you can see the credit. Below the credit title, you can see liability, owner's capitals, revenue. If any of them increase, that will go to credit side, and if any of them decrease, that will go to the debit side.
Difference between debit and credit. Debit. A debit is an accounting entry that either increases an asset or expense account or decreases a liability or equity account. It is positioned to the left in an accounting entry. Credit. A credit is an accounting entry that either increases a liability or equity account or decreases an asset or expense account. It is positioned to the right in an accounting entry. Second difference is all accounts that normally contain a debit balance will increase in amount when a debit left column is added to them, and reduce when a credit right column is added to them. Credit. All accounts that normally contain a credit balance will increase in amount when a credit right column is added to them, and reduce when a debit left column is added to them. Third difference is debit cards are like a digitized version of checkbooks. They are linked to your bank account, usually a checking account. Credit cards are different. They offer a line of credit. Example, a loan. Fourth different, debit. The types of accounts to which this rule applies are expenses, assets, and dividends. Credit. The types of accounts to which this rule applies are liabilities, revenues, and equity. The fifth difference, most debit cards are free with a checking account at a bank or credit union. Credit cards have the advantage of rewards programs, but such cards often require an annual fee to use. Why we use debit and credit? Most debit cards are free with a checking account at a bank or credit union. They can also be used to conveniently withdraw cash from ATMs. Credit cards have the advantage of rewards programs, but such cards often require an annual fee to use. Financial responsibility is a big factor in credit card use. It is easy to overspend and then get buried in overwhelming credit card debit at very high interest rates.
Hello sir, Assalamu alaikum. My name is Afsan Hassan Jeni and my ID is 1511155278. Today our presentation topic is debit, credit and its journal. Now first of all I want to say what is debit balance and credit balance. If if asset, drawings, expense are increasing, then it will be debit and it is called debit balance. If they are decreasing, then it will be credit. On the other hand, liabilities, owner's capital, revenue are increasing, then it will be credit and it is called credit balance. If they are decreasing, then it will be debit. For example, if a company borrows cash from its local bank by a note, so here cash is increasing, so it will be debit. And note payable is a type of liabilities, so here it is also increasing, so it will be credit. Debit and credit rules. If asset, revenue, expense are increasing, then it will be debit, and debit is always stay on the left side. On the other hand, capital, liabilities, revenue are increasing, then it will be credit, and credit is always still on the right side. For example, the owner brings cash from his personal account into the business. Here, cash is increasing, so it will be debit. As cash is debit, so here cash is still on the left side. On the other hand, owner's capital is also increasing, so it will be credit. As owner's capital is credit, so it is still on the right side. Similarly, office supplies are purchased on account. Here office supplies is increasing, so it will be debit. As office supplies is debit, so it is stay in the left side. On the other hand, accounts payable is also increasing, so it will be credit. As accounts payable is credit, so it is stay on the right side. So that's it. Thank you.
This is an example of general journal. The first transaction is 1st January invested 50,000 cash in the business. Your cash is an asset, and when the asset is increasing, the amount is debit, and when the liabilities and owner's equity is increasing, the amount is credit. Your cash is increasing, so 50,000 cash is debit, and owner's capital 50,000 is credit. The second transaction is 3rd January purchase land or furniture or equipment costing 20,000 for cash. So land, furniture and equipment is an asset and it's increasing, so 20,000 is debit and cash is decreasing, so the cash is credit. The third transaction is 4th January input advertising expense of 1800 on account. Here the advertising expense is increasing, so 1800 is debit, advertising expense 1800 is debit, and accounts payable is liabilities and accounts payable is credit. The fourth transaction is 5th January paid salaries to employees 1500. Salaries, here the salaries expense is increasing, so 1500 salaries expense 1500 is debit and cash is decreasing, so the cash 1500 is credit. The fifth transaction is 7th January hired bulk manager at salary of 4,000 per month effective on future annuities.
Here hired park manager at salary of 4,000 per month, but he is not performed or paid, and he is effective on future and day. So that's why we write here no entry.
Now come to the transaction at January 8. Here the question is paid 1,650 cash for a 1 year insurance policy. Here we see the solution, and the solution is the prepaid insurance is 1,650 cash on debit, and the cash is on carry. Because insurance policy is one kind of prepaid insurance, and prepaid insurance is one kind of asset. So assets is increases, so assets is debit, and the cash is decreases, so cash is credit. Now come to the next transaction. Here we see here we see withdraw 1,000 cash for personal uses, and here we see the solution. The solution is drawings 1,000 on on debit side, and cash 1,000 on credit side. Why? Because withdraw cash for personal uses. The company owners withdraw cash for his personal purpose. So drawing is debit because cash is decreases and the cash is credit. Now come to the next transaction at January 11. Here received 6,800 in cash for service performed, and here we see the solution. The cash is on debit side, and the service revenue is on credit side. Why? Because the cash is increases and the whole cash is added on the service revenue side, and the service revenue side is increases. So we know that revenue is one kind of revenue is always sit on the credit side. So we add service revenue is on credit side, and the cash is on debit side. Now come to the next transaction at January 13. Here we see hired a secretary receptionist at a salary of 2,000 per month. Here you see the solution. Here you see the solution that which is account title is no entry, because here we say that hired a secretary receptionist, not yet not paid yet. So we can say that there is no entry. Now come to the next transaction at January 14. Here we see purchase 2,500 cash of supplies on account for from Reed Supply Company. And here we see the solution. The solution is supplies 2,500 on February cash on debit, and accounts payable 2,500 on credit. Why? Because here we see that one account. On account means one kind. We have to add this cash on liability side. Um, so we uh, so we uh, we post accounts payable on credit side and supplies on debit side. Now come to the next transaction at January 15. Here we see paid office rent of 9,900 cash for the month. And here is the solution. Here is rent expense 900 on debit side, and cash is on credit side. Why? Because paid office rent is one kind of rent expense, so we add rent expense on debit side and cash on credit side, because cash is decreased.
After completing January 14, now in transaction January 15, here said that paid office rent of 900 cash for the month. So here the rent expense will be debit and the cash will be credit, because cash is decreases and the expense is increased. In the next transaction, here saying that completed task assignment and billed client 3,200 for services provided. So the money will be received in future. That's why the account receivable will be debit and all the money will be added into the revenue. So the service revenue will be 3,200 taka in credit. In January 18 transaction, here saying that received 3,500 advance on management consulting engagement. Here the cash is increased, so it will be added into the debit section, and as the money is received as advance, so the earner service revenue will be credit and it will be added into the
credit section. Now, here say that page 60% of balance due reach supply company. In transaction 14, we saw that there was a due which was 2,500 taka. So here the company paid 60% of that money, and the amount is 1,500 taka. That's why the accounts payable is 1,500 taka, and as the cash is decreases, so the cash will be into the credit section, and it will be 1,500 taka in credit part. Now here saying that purchased Hiran's golf land for 15,000 cash. Here cash is decreases, so cash will be added into the credit section, and all other the amounts that land, shade and equipment will be added into the debit section.
Well, now I am discuss about some transaction. First, we see that January 23rd, they purchased golf discs and other equipment for 1,050 from Innova company payable in 30 days. Now we see the solution that account here, the account title equipment, because they purchased some equipment and the price is on 1,050 and this goes to the debit balance. Now they are not paid yet, so it's account payable. The accounts payable is 1,550 and it's a credit balance. Now we see the next transaction. The next transaction is January 25th, and it's sold 150 coupon books for 10 each, and each book contains 4 coupon that enable the holder to play one round of Debit. So they sold 150 coupon books, so the price is 1,500, and so the account title here goes that they cash 1,500 and the unearned service revenue, because they are not provide the service yet, so unearned service revenue is the credit balance and the cash is the debit balance. Now we see the next transaction, that January 27, that provided dental service and bill insurance companies 5,100. So they provide the dental service, and so that the dental service and the company didn't pay yet, so it's the account receivable balance, and it's the debit balance. And the other is the service revenue, because they provide a service, then so the service revenue is 5,100 taka. Then January 30, that they signed a 2 years rental agreement on a warehouse and paid 24,000 cash in advance for the first year. So it's a rent, and they are paid first, so it's a prepaid rent, and so now the account title is prepaid rent and it's a debit balance 24,000, and the cash is a credit balance, and it's also 24,000. And the last transaction is January 31. January 31, they receive utility bills and the amount of 350 to the paid next month. And so if the solution is that it's utility expense, and the utility expense is a debit because it's an expense, and the account payable because they are not paid yet, so utility bills is a debit balance and the account payable is credit balance. So that's all from us. Thanks for watching our video.
Yeah.